Hello, everyone. I am Nathan Corroy alongside Dan Brown here at Richardson Capital Management, and we are here today with the economic and investment update for the month of July 2026. Well, Dan, despite the positive returns we've seen in the broader financial markets year to date, we saw a bit of a pause in the month of July with most equity benchmarks posting slightly negative returns and fixed income coming in negative as well. While there's been no shortage of headlines hitting the news, the biggest story continues to be the conflict in Iran and the implications that has. So as we came into the month of July, we had a ceasefire in place that ultimately collapsed as the struggle over that Strait of Hormuz continues. Later in the month, we saw, an agreement kind of in place to pause the fighting that ultimately collapsed again. The impact of that has really been on the price of oil. So we came into the month with oil at a price of about $69 per barrel, ended up hitting a peak of around $93 per barrel before settling in around 85 at the end of the month. Could you share a little bit of insight on why that matters for the financial markets?
Yeah, so the linkage that we're paying attention to is the impact of higher energy prices on inflation and what that means for the Federal Reserve as far as them potentially raising interest rates to fight that higher level inflation. So as you mentioned, the military escalation kicked up again in the month of July, leading to a spike in energy prices. No doubt that's going to feed through the economy in the form of higher inflation.
Right.
And one of the Fed's mandates is to fight inflation. So let's talk directly about what we learned at the Fed meeting in July, late in the month. So this was the second meeting for Kevin Warsh under his tenure. And he came in, a couple months ago being fairly hawkish, talking about the mandate to fight inflation. And for two meetings now, the Fed has paused on interest rates. There was a little bit of blowback in the financial market, specifically on the fixed income side of things, with the rising level of interest rates. So we saw, for example, the U.S. 10-year close out at year-to-date highs at the end of the month at about 4.75%. So that led to the negative returns for the fixed income market. And I think the market's coming around to the expectation that the Fed's probably going to need to raise interest rates at a future meeting here sometime in the second half of the year, mainly because this Iran conflict doesn't seem to be going away.
Right.
And as long as there's, the conflict is continuing, energy prices are going to stay high, which is going to lead to a higher level of inflation.
Right.
And again, one of the Fed's dual mandates is to fight that inflation. And one of the ways to fight that would be through higher interest rates.
Got it. And Dan, another key issue hitting the financial press has been kind of centered around AI, with investors starting to express some caution and concern around the level of spending, how it's being spent, and if we're getting too far down that road. Last month we talked a lot about the divergence we're seeing between the big spenders in the AI space, so the hyperscalers like an Amazon or an Alphabet, relative to the net beneficiaries of that being the semiconductor companies like an NVIDIA or a Micron. Has anything changed in that theme in the last month, and how do we see that playing out through the rest of the back half of this year?
Yeah, so that theme kind of continued, from June into July. And so just to go back and talk about the graph that we showed last month, we basically showed kind of a total return for the technology sector broken down into a couple different components. And as you mentioned, the semiconductor stocks have been the clear beneficiary, right, because they're the ones that have seen the insatiable demand for all their semiconductor chips. And it appears as though that's going to continue for at least a year or so based upon the supply outlook that they've given us. So this month, we're kind of tailoring on that same theme,
right,
and just talking about how the big hyperscalers are really funding all of this tremendous amounts of CapEx expenditures. So this year, we think that the CapEx expenditures from those hyperscalers could be upwards of $800 billion, possibly $1 trillion, and in 2027 could be even higher. So the graph that we're showing this month just looks at how those companies are spending and where it's coming from. So we're looking here at free cash flow between two different components, one being those hyperscalers, and the other being the semiconductors. So the semiconductors are the blue line that we're looking at, and the hyperscalers are the gold line. And you can see really for the first time in a while why investors are concerned. And that's because the gold line, the hyperscalers' free cash flow, is dipping almost towards zero by the end of the year. And that's causing a lot of concern. So it wasn't as much of a concern a couple months ago and a couple quarters ago when those companies were funding all the AI spending from their strong earnings.
Right.
And now they're having to dip into things like issuing bonds, issuing additional stock, and suddenly, the free cash flow is quickly evaporating and going to zero. That's causing a lot of investor angst out there. But make no mistake, the clear beneficiaries have been the semiconductor stocks. And we wouldn't be surprised if the hyperscalers underperform for a little while longer until either their pace of their spending slows down or they can show some tangible benefits of all the spending that they've done over the past year or two.
Well, Dan, as we've been fairly consistent on for the last few quarters at least, we tend to look through the noise of the headline risks and look at the true building blocks of the economy and focus on things like corporate earnings, unemployment, and interest rate policy. Have there been any major updates on those items that would lead us to any kind of change in our outlook through the rest of the year?
Not really. In fact, the outlook is still constructive. And the biggest thing that we're paying attention to from a fundamental building block perspective is just corporate earnings and the direction there. And as we've talked about repeatedly here on these videos and written in our updates, those results have been very, very strong, and they continue into the second quarter. So to end the month of July, we're about 60% of the way through second quarter earnings season. And once again, it's another quarter where companies are beating consistently on the top line for revenue and then the bottom line for earnings growth. So just to tell you where we are at the end of July, revenue growth is coming in at about 14% year over year growth. And then earnings growth coming in at kind of a silly number of 47% earnings growth. And we see 8 of 11 sectors double-digit earnings growth. So it's hard to be negative in that type of environment, especially on stocks. And we would think that that's going to continue probably for a couple more quarters as all this CapEx spending for the hyperscalers that we just talked about, that kind of continues.
Right.
And that could actually ramp into 2027. So again, it's kind of hard to be negative on the financial markets here. So as long as those double-digit earnings growth continues, we think the direction of stocks is upward.
Sure. Well, with that, we want to thank you for watching. As always, we appreciate your continued trust and support, and please feel free to reach out at any time with any questions or concerns.